Hello everyone, welcome to the 188th episode of me learning how to trade in Forex. So in the last episode we went through the three videos in trading options, so buying versus selling options, option expirations and implied volatility intro. So notes from that is option trading strategies can be bullish, bearish or neutral. Option contracts grant the holder the right but not the obligation to buy or sell an asset at a predetermined strike price before a specified expiration date. So these options contracts derive their value from two components, the extrinsic value and the intrinsic value. The intrinsic value represents the real value of the option at expiration based on the underlying asset's price relative to the strike price. The extrinsic value accounts for the time remaining until the expiration and the implied volatility of the asset. To be good at options trading, you need to build a thorough understanding of the contract parameters such as the strike prices and expiration dates, the mechanics of exercising or being assigned options contracts, and also learn the Greeks. So option buyers need the strike price to be in the money by more than the extrinsic value they paid to be profitable at expiration. Buying an option is like buying an insurance contract, selling an option is like being an insurance broker. More options, more expiration dates equals more flexibility. Monthly expirations are typically the most liquid. Options that have intrinsic value will turn into shares of stock if held through expiration. Long calls and short puts turn into 100 long shares. Short calls and long puts turn into 100 short shares. Implied volatility is the expected potential movement of a stock's price presented in a one standard deviation basis, which is 68.2% of the occurrences. Therefore, implied volatility is not 100%, so take this into account when making decisions. Implied volatility rises from lows and falls from highs. Option prices drive implied volatility, however, implied volatility doesn't drive option prices. High implied volatility indicates rich option prices compared to the stock price, relative to the stock price. Low implied volatility indicates cheap option prices relative to stock price. If the same two underlying stock price was compared and there's two different premiums with the same expiration cycle, it means they have different implied volatility percentages as well. So now we're on to expected move explained, and as I mentioned in the last episode, I need to start making notes during the videos because right now I'm just reading, like watching the videos through and not making anything, so need to do some active listening. So I haven't made notes up until expected move explained. So let me just write a note somewhere. So expected move explained is where I started making notes throughout the video instead of at the end. Right, okay, let's go. Expected move explained.
As we started to see in the first video, implied volatility can be used
the dude changed. Okay,
in a variety of ways when trading options. In this video, we want to focus more specifically on one of those ways, calculating the
implied volatility can be used to determine implied volatility can be used to determine option prices. Calculate the expected move of a stock. Calculate the expected move of a stock. And measure directional risk.
Specifically on one of those ways, calculating the expected move of a stock. In other words, based on a stock's IV, we are able to forecast its anticipated range of stock price movement.
So based on the implied volatilities, what is it? Based on the implied volatility, you can find out a range of how much it will move. Right, that's what he said.
Based on a stock's IV, we are able to forecast its anticipated range of stock price movement. In general terms, if stock ABC has an IV of 20% over the course of an expiration cycle, and stock XYZ has an IV of 10% over the course of the same expiration cycle, then the market is anticipating twice the potential movement in ABC compared to XYZ. Of course, ABC and XYZ will be trading at their own unique prices, so the actual dollar values of these estimated ranges could be quite different. Still, given where a stock currently sits,
Right, okay, so,
IV,
I wish there was like a transcript to this.
we are able to forecast its anticipated range
Can be used to calculate expected move of stock.
of stock price movement. In general terms, if stock did move of a stock. In other words, based on a stock's IV,
Based on a stock's implied volatility,
we are able to forecast its anticipated range
stock's anticipated range can be forecasted based on a stock's implied volatility on that.
of stock price movement.
Of movement can be forecasted based on that stock's implied volatility. Right, okay.
In general terms, if stock ABC has an IV of 20% over the course of an expiration cycle, and stock XYZ has an IV of 10% over the course of the same expiration cycle, then the market is anticipating twice the potential movement in ABC.
If one stock has 20% implied volatility and another stock has 10% implied volatility, then the 20% is expected to move twice as much as the 10%, right?
Cycle, then the market is anticipating twice the potential movement.
Yep, so 20% implied volatility and another like 10%, then the first stock has twice the potential movement,
Is anticipating twice the potential movement.
has twice the potential movement as the second stock. Stock is anticipated to have twice the potential movement as a second stock.
In ABC compared to XYZ. Of course, ABC and XYZ will be trading at their own unique prices, so the actual dollar values of these estimated ranges could be quite different. Still, given where a stock currently sits, the implied volatility, and the time until expiration, we can compute the likely range of prices over that time period.
So expected move is current stock price times by the implied volatility times by the square root of days till expiry over 365. The expected move is the amount that a stock is predicted to increase or decrease from its current price. So the expected move is the amount that a stock is predicted to increase or decrease from its current price,
i.e., the expected move. Of course, this is merely an estimate and literally anything can happen.
that the expected move is just an estimate and anything could happen.
But approximately 68% of the time, stock prices will fall within this range on average.
Now 68% is from that isn't a standard deviation basis.
For example, let's look at Apple at a price of $170 and an IV of 25%. Over the next year, the expected move is simply plus or minus $42.50, or 25% of $170. But if we were to focus on only the next 45 days to go in the current expiration cycle, the expected move would shrink down to plus or minus $14.90. In other words, over the next 45 days, the market is expecting Apple to move in about a $30 range, almost $15 up and almost $15 down. We can use this formula to adjust our traditional annual implied volatility to any time frame we want. Pretty cool, right? Now, market randomness and unpredictability is $14 to move almost pretty cool, right?
The expected move is calculated. Let's do something a little fancy here. So equation, new equation. Expected move is equal to current stock price times implied volatility times square root of, oh no, that's the wrong place to put it in. Here we go. Square root of DTE over 365. So fraction, top 1 days till expiry over 365 days. Just an estimate. So what do you say about the 68.51?
Now, market randomness and unpredictability is $14.90. In other words, over the next 45 days, the market is expecting Apple to move in about a $30 range, almost $15 up and almost $15 down. We can use this formula to adjust our traditional annual implied volatility to any time frame we want. Pretty cool, right? Now, market randomness and unpredictability dictate that this anticipated range will always be symmetric, with an equal chance of an up move relative to a down move. Hence, expected moves will always be given in a plus-minus format.
So the formula output, the expected move formula output will always give a plus minus even format, as it gives out a symmetrical output. So i.e. plus or minus, let's do £15.
The expected move derives its name from the normal distribution. Given enough observations and over enough time, stock price movements and our results from trading those stock price movements will fall into a normal distribution, or bell curve. Basic statistics shows us that approximately 68% of the time, the observations from a normally distributed data set will fall between plus or minus 1 standard deviation. This is no coincidence. It maps perfectly into our expected move calculation, with the upper edge of the range reaching plus 1 standard deviation and the lower end of the range reaching minus 1 standard deviation. Therefore, as out-of-the-money premium sellers, we love to use the expected move and standard deviation markers as reference points for our trades, strategies, and strike selections. For example, if IV expands, resulting in very wide standard deviations relative to the stock price, maybe I sell a 1 standard deviation strangle and bet that the standard deviation range will collapse. If it does, that means option prices have deflated and I may be able to buy back the strangle for a lower amount than I sold it for, resulting in a profit. And if IV stays the same, we still have a much wider profit zone than we would have if we had sold a 1 standard deviation strangle in a low IV environment. In a nutshell, this is one of the most powerful aspects of tying standard deviation into implied volatility and option prices. It helps us put context around option prices and the expected move ranges they're presenting to us. Check out the written content below for more information, or proceed to the next video where we'll dig a little deeper into volatility mean. Bet that the standard deviation is no coincidence.
I have no idea what he was talking about. Let me just rewatch that again. So
it maps perfectly into our expected move calculation, with the upper edge of the range reaching +1 standard deviation and the lower end of the range.
Right, okay, so that plus or minus 1 standard deviation is what gets out from the formula.
Reaching -1 standard deviation. Therefore, as out of the money premium sellers, we love
out of the money premium sellers. So you're basically shorting shares, right? If you're out the money premium.
To use the expected move and standard deviation markers.
Expected move, standard deviation markers
as reference points for our trades, strategies, and strike selections. For example, if IV expands,
if implied volatility expands,
resulting in very wide standard deviations,
so it has really wide standard deviations
relative to the stock price,
because the expected move, so if the stock price doesn't change, implied volatility increases, then that expected move is gonna increase as well, right?
Maybe I sell a 1 standard deviation strangle.
So 1 standard deviation strangle. Strangle is sell 1 standard deviation strangle. So you're shorting a strangle, right? So short strangle. In a short strangle, you're selling the calls and put options. So you're hoping the underlying asset price will show a little volatility to remain somewhere between the 2 strike prices so that the options you sell expire worthless. It would remain between here, the put and call option. So the price won't reach here, so then it will remain worthless. Right, okay. Put call option. So selling a put option. Selling a put option if you're bullish about the prospects in the underlying market. So you think it would rise, or if you thought the price is likely to stay the same. Sell a put, sell a call if you're bearish. Sell a put if you're bullish about the prospects, so you think it will rise or likely stay the same. So your put option price here is here. So your put option is priced at here. So you sold it. There you would have hoped the price, if it's bullish, go up that way, right? No. Wait, what? Sell a call option if you're bearish about the aspects. So you think it would fall or stay the same. But this isn't the option price graph, this is just a bell curve. So it's got standard deviations in it instead. Forget about the put and call options. Set a long strangle, so as long as the price stays in here, make a profit, but if the price moves out, then we'll make a loss. Right, okay, so what has he said?
In very wide standard deviations relative to the stock price, maybe I sell a 1 standard deviation strangle and bet that the standard deviation range will collapse.
So selling a long strangle, hoping the underlying will show little volatility, remain somewhere between the 2 strike prices. So you're hoping the price will remain between these 2 arrows, and if the implied volatility decreases, if this value decreases, then the expected move is also going to decrease as well. So if the expected move is going to decrease, then that plus or minus that number here is going to decrease as well. That decreases, then that should shrink up because it decreases.
And bet that the standard deviation range will.
But you still got your contract strangle at the same price. So if it decreases,
collapse.
right, okay, so that decreases.
If it does, that means option prices have deflated.
Option prices have deflated. So price has gone down. Why has the price gone down from this? Because you're originally hoping that the price will stay within this bit, but now it can go in this bit as well and you still make a profit. So what does that mean?
And I may be able to buy back the strangle
Buy back the strangle.
for a lower amount than I sold it for.
You can buy it back for a lower amount than you sold it for. Buying back the strangle for a lower amount than you sold it for. How can you buy it back for a lower amount than you sold it for though? Is it because of the decrease in the price that you can buy it back for a lower amount than you sold it for? Don't know, to be honest.
Resulting in a profit. And if IV stays the same,
So if you buy it back lower than you sold it for, okay, yeah, you do make a profit there, yeah. So if you shorted the option at 15, managed to buy back at 3, then you make a 12 profit. But if it stays the same,
we still have a much wider profit zone than we would have if we had sold a 1 standard deviation strangle in a low IV environment.
right, because the prices, you have a bigger range to work with basically. I think that's what it's trying to say. Yeah, so you've got a bigger range to work with.
In a nutshell, this is one of the most powerful aspects of tying standard deviation into implied volatility and option prices. It helps us put context around option prices and the expected move ranges they're presenting to us. Check out the written content below for more information or proceed to the next video.
For what could happen 68% of the time. But anything could happen. Expected move is just a 1 standard deviation. But anything else could happen. So the next video, volatility mean reversion.
In the first 2 videos of this series, we've learned about implied volatility and its basic characteristics. We've seen that IV is often the hero of the option pricing model, even more so than the options price itself.
What was that? C equals SND1 minus ND2 times YKE to the square of minus RT. What is D? C.
And we've learned that IV shares a positive relationship with that option price. We've also seen how IV can be used to determine a stock's expected move over a given expiration cycle. Higher IV tells us that option prices are relatively higher, and lower IV
High implied volatility, so higher implied volatility means higher option prices. Lower implied volatility means lower option prices. Well, let me just do this. So expected move explained. So this bit here, I think. Expected move explained. And this is volatility mean reversion. Volatility mean reversion.
In the first 2 videos of the IV share, stocks are given are relatively higher, and lower IV tells us that option prices are relatively lower. Well, in this video, we're going to expand on that relationship with the idea of volatility mean reversion. Put very simply, volatility mean reversion is nothing more than volatility's tendency to revert or return back to its historical average.
Volatility mean reversion. So volatility mean reversion is the volatilities. Well, why do I spell it out? Volatilities. Tendency to revert or return back to its historical average.
Periods of higher IV tend to be followed by periods of lower IV.
Periods of higher volatility, implied volatility, tends to follow periods of lower implied volatility.
And periods of lower IV tend to be followed by periods of higher IV,
which follows periods of higher implied volatility.
It is less common for IV to remain elevated at high levels for long periods of time, or suppressed at low levels for long periods of time.
So it's uncommon for implied volatility to stay high or low for long periods of time.
On a clock, volatility likes to swing back and forth between high points and low points. In other words, expanding volatility is often followed by contracting volatility, and contracting volatility is often followed by expanding volatility. As we alluded to in earlier videos, we see IV as opportunity, and we see volatility mean reversion as an accelerant to that opportunity. Here's how. Remember that if we buy options, we want their prices to rise. This is no different than purchasing any financial asset where an increase in its price would allow us to sell out of our position at a profit. When we sell options, however, we want their prices to fall. This would allow us to buy back the option that we sold at a lower price, also yielding a profit.
Okay, so write that down again. Buying options, hoping for an increase in price to sell it back for a profit. Selling options, hoping for a decrease in price to buy it back, sell it for a higher price for a profit. Selling options, hoping for a decrease in price to buy it back, to buy it for a lower price for a profit. Sell it for a higher price for a profit. Selling options, hoping for a decrease in price to buy it for a lower price for a profit.
Profit. When we sell options, however, we want their prices to fall. This would allow us to buy back the option that we sold at a lower price, also yielding a profit. In either scenario, we are following the simple framework of buying low and selling high, or selling high and buying low. Well, if we take our understanding of IV and option prices and combine that with IV's tendency to mean revert, then we have a powerful combination. When IVs are low and volatility is contracting, we typically look to buy premium.
Okay, so
when IVs are low,
when implied volatility is low
and volatility is contracting,
and volatility is decreasing,
we typically look to buy premium.
I should call it contracting. volatility is contracting, buy premium. Typically buy premium.
Not only are we buying options at cheap prices because low IVs have driven them lower, but we are also positioning ourselves to benefit if volatility reverts back to its higher mean and option prices rise. This is typically achieved through calendar spreads, diagonal spreads, or debit spreads. Now when IVs are high and option prices rise. This is typically achieved through calendar spreads.
Typically achieved through calendar spreads,
Diagonal spreads,
and
or debit spreads. IVs are high and volatility is expanding.
When implied volatility is high and volatility is expanding,
we typically look to sell premium.
Wait, let me say that again.
Debit spreads. Now when IVs are high and volatility is expanding, we typically look to sell premium.
So typically sell premium.
Here, we are selling options at rich prices because high IVs have driven them higher.
Higher implied volatility have driven prices higher. So remember when we wrote, where is it? Option prices drive volatility. Implied volatility doesn't drive option prices. What? Wait a second.
Driven them higher. Have driven rich prices because high IVs have driven them higher.
High implied volatilities drive prices higher. But didn't they say implied volatility doesn't drive option prices? Only option prices drive implied volatility. Eh? Wait a second. Let me just...
When IVs are low and volatility is contracting, we typically look to buy premium. Not only are we buying options at cheap prices because low IVs have driven them lower, but we are
low implied volatility drive option prices lower. Huh. Okay. I guess.
also positioning ourselves to benefit if volatility reverts back to its higher mean and option prices rise. This is typically achieved through calendar spreads, diagonal spreads, or debit spreads. Now when IVs are high and volatility is expanding, we typically look to sell premium. Here, we are selling options at rich prices because high IVs have driven them higher. And we are well positioned to benefit if volatility reverts back to its lower mean and option prices fall.
Wait a second,
And to benefit if volatility reverts back to its lower mean and option prices fall.
Applied volatility. Because less volatility is less risk, so prices fall.
Most short premium strategies could benefit from this contraction. Check out the
So short put typically achieved through short put options, strangle and straddle. Short put, strangle, straddle.
contraction. Check out the written content below for more information or proceed to the next video where we'll talk. Check out the
Yeah, these are actually really clear diagrams. These are the diagrams that we're looking for. So short, put, let's make it 20, strangle, whoops, and straddle.
This contraction.
Yeah, boy.
Check out the written content below for more information, or proceed to the next video where we'll talk implied volatility.
Nice. So sats. Let's do it for a long one as well. So typically achieved through diagonal spread, and then we got debit spread. So
ourselves to benefit if volatility reverts back to its higher mean and option prices rise. This is typically achieved through calendar spreads, diagonal spreads, or debit spreads. Now, when IVs are high and volatility is expanding, we typically look to sell premium. Here, we are selling.
yeah, so these diagrams really helpful to pinpoint what's going on. I know that in some of the previous videos they showed them, so it's just really obvious at a glance where you make a profit and where you make a loss, you know, and you don't have to like read 2 or 3 lines to figure out what's going on. So you can see in the diagram here, make loss, profit, loss, loss, profit, loss, loss, profit. So really good. Yeah,
Between the two presents us with yet another opportunity.
Okay, so I'm going to leave this episode here then. In the next video, we're going to carry on with implied volatility versus, I'm guessing that's relative volatility. So yes, just make a note on that. So implied or IV versus RV. Cool. So thank you all for watching, and I shall see you all in the next video. Laters.